where we are now and where we're headed are night and day. We ain't seen nothing yet.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The Sahm Rule, a widely monitored recession indicator, triggered on Friday. Now, some analysts are arguing that it's too early to worry about a slowdown, that the economy is too strong currently. But others warn the U.S. may already be in recession. So which is it? For answers, we're fortunate to speak today with Danielle DiMartino Booth, CEO and Chief Strategist of QI Research and author of the book Fed Up, an insider's take on why the Federal Reserve is bad for America. Danielle, thanks so much for joining us today.
It's great to be back with you, Adam.
Oh gosh, Danielle, it is always a pleasure. I know you've got a very busy schedule. Thank you for making time to come join us today. Lots to talk about, and I know that you have been more than normal the focus of FinTwit recently. You put out an interview not that long ago about the recession, saying all hell, or at least the title was, I don't know if you picked it or if the channel did, all hell is going to break loose. And there's been a lot of discussion flowing out of that about recession. I can't wait to dig into that for you. But before we do, I'd just like to ask a general starting question that I like to ask you every time you come on. What's your current assessment of the global economy and financial markets?
So I think that what we're witnessing right now is kind of the last hurrah of quantitative easing. I mean, we were expecting for the carry trade in Japan to be unwound. I don't know that we were expecting the volatility to be quite as violent as it has been, but the unwinding of the carry trade was fully anticipated. I think what was less appreciated was the Bank of Japan cutting their quantitative easing program in half. So this was the last standing source of ongoing liquidity into the financial system. QE is fungible. It's always been fungible. Markets are agnostic as to the form QE takes, as to who's conducting QE. But now that we're pulling it back, we are beginning to see what the other side of the mountain is going to look like. And let's just say we need to have some protective gear on. With this said, before the Bank of Japan even made its move, Germany fell back into recession. Chinese imports completely cratered. We saw German trade activity, exports, imports come in much lower than what were expected subsequent to this most recent data we've got. So the global economy, as far as I can see, because I include the United States in this, the global economy is in a recession. And the question becomes one of then, where is the next new source of liquidity going to come from? And where is the next growth source of economic output, source of GDP? Where are we going to get that next burst of GDP to begin to push us in the opposite direction? During the 2007-2009 global financial crisis, the Great Recession, it was China. In the 2015-2016 global industrial recession, it was China. It's not going to be China this time. And China, as far as we can tell, is exporting deflation as quickly as it can. So it's going the opposite direction, trying to offset the disaster in its property development sector. So it's a big open-ended question as to what's going to be the next marginal source of growth and marginal source of liquidity.
Okay, I actually think that is a great question. I think you asked it in a really concise way, which is, where is the next marginal source of growth? I think coming into this year, folks thought it was going to be China. They thought that, hey, China's picking itself back up, and that's what's going to carry, the global economy forward this year, help re-spark growth. That hasn't really happened. Now, in terms of where the next liquidity is going to come from, I mean, is that China right now? I think China is back to doing some sort of economic stimulus. I guess the question is it big enough to matter here? But you're right, beyond them, nobody else is really doing stimulating right now.
And we have to bear in mind right now, it's fascinating because every week Citigroup publishes information on hotel occupancy, revenue per day, average daily rates, and it's a 99% US centric report. But they have one chart in this report. I recently reached out to the analysts and said, why is this in here? That shows Chinese revenue for every available room. And boy, has it come down and stayed down. It stayed in negative territory. Why do I answer your question in a sideways fashion? I do because even if China's in the process of trying to stimulate, it's all being kept inside of China. And it has to be. It must be, because the Chinese economy is on its knees. So right now it can only afford to stimulate its domestic economy. If it could afford to stimulate the international markets, we would be seeing it, but we're not. Again, look at Germany, which just fell back into recession. Germany is always a great proxy for what's happening in China.
Okay, so all right, so that I think sets the stage for your comment there, where you say the global economy may currently be in recession. I want to get more specific to some of your recent recession comments, but real quickly, when you say what we're seeing with Japan really is the last hurrah of QE, think about it like a relay race around the world. And for a long time, countries were doing QE together, and as you said, it's fungible. So when one country hands the baton to another, that can keep the global QE pie still expanding. But now that the carry trade's been unwinding, Japan's been having all of its issues. We're going to see what happens next. Let me ask you this. So one of the things I talk about all the time on this channel is the lag effect. Because once the QE tide stops rising, or even worse, starts receding, what are you left with? You're left with a higher cost of capital structure than you had before, right? It's almost like putting weights on somebody. I'll try to see if I can come up with an analogy on this. Putting weights on somebody who also has, I don't know, balloons tied to them. But when you start cutting off the balloons, all they have left is the weight on them, right? So you're sort of nodding as I'm saying this, but are you of the school of thought that says, hey, now with the last hurrah of QE ending, will the lag effects really start to show up in earnest? Because many have argued, myself included, just being super transparent, that the tremendous amount of liquidity that's been pushed into the system, both with the COVID stimulus response, but with the continued fiscal spending and whatnot, and the draining of the reverse repo program and everything that we saw through 2023 and into this year, are we now kind of where the piper is showing up and demanding to be paid in terms of the lag effect?
I think we are, and we're seeing it, and this will segue beautifully into the labor market, but we're seeing it because the producer price index is reflecting the highest on record in terms of what it costs to declare bankruptcy. And price is a function of supply and demand. And the demand for bankruptcy attorneys is higher than it's ever been. And therefore, the prices that they're charging, as reflected in a little itty bitty line item in the PPI about bankruptcy, is as high as it's ever been. Now, we know, because of dailyjobcuts.com, with data that goes back to 2009, we know how many companies are closing every day in America. And it might be a Kellogg's plant that's been open in Omaha for 75 years that announced it was going to be closing, taking 550 jobs with it, prompting an institutional client of mine to say, who's in Omaha, by the way, who said, wow, if Omaha is a safe place in the US economy, it is the last to ever be hit by recession. It's saying something that there is an economic disaster right here on our front lawn. But the rapidity with which we're seeing the bankruptcy cycle accelerate, the sheer number of closings that we're seeing of businesses, and the persistence of it. The founder of dailyjobcuts.com reached out to me a few days ago and he said, Danielle, it's not the level. It's that the level's at a very high level, and staying there. You're just seeing carnage continued day after day after day. And I think that that is the tell. That is the tell that says, according to my analysis and a chart that I keep on an ongoing basis, Jay Powell has been higher for longer than Paul Volcker. Where do you see that lag effect manifest? In companies going bye-bye. And that's exactly what we're seeing. And we're seeing a massive spike in consumer bankruptcies as well.
Okay. I really want to dig into that last one with you, but I'm going to punt that when we get to the consumer section. Okay, so we're jumping into labor. I've got one question I'm going to go back to just about general recession in a moment, but let's keep digging through here. So I follow dailyjobcuts.com as well. I know we both subscribe, or both followers of it on Twitter. And you're right, it's this daily drumbeat. I mean, it's pretty crazy not to watch that and just feel like there's this cascading wave of increasing layoffs rolling across the country. Now, if we look at data like quits and hires, those numbers have come down pretty dramatically as well. The Great Resignation, totally over, as I've tweeted about for a long time, predicting, which I now think is the case. I think we're now entering the please may I not get laid off era. Like hires are back down to like, I'm doing this from memory, but like 2018, 2017 levels. And so, those show that the power balance has really swung back in favor of the employer here, which you would expect if employers are not hiring people or hiring people a lot less and laying more people off. Where I'm going with all this is, okay, so you and I have been tracking the jobs numbers very closely for a long time now. I think we've been incredibly stymied by the general jobs numbers, right? The payroll numbers that come out and the JOLTS reports, which for a long time just seemed far too rosy given what we were seeing in the rest of the economy, right? And now we've seen some erosion in those numbers, not a lot, and it's only very recent, but the employment rate is rising, and it's now rising fast enough to trigger the Sahm Rule, which I mentioned in the intro. But we're still at historically low unemployment numbers. Now, I've talked with a number of the people on this program, and you've written about this a lot, that there's a lot of corroborating data that suggests that the BLS payroll numbers are vastly overstated. If you go to the QECW, I think some people's estimates are that it's something like, I don't know, 800,000 jobs overstated or something like that.
Remember,
Yeah.
the quarterly census of employment and wages that is released by the Census Bureau is not a survey at all.
It's millions of inputs, right?
It's a legal report that every company in America is required by law to file a report once a quarter to the Census Bureau providing headcount. It's not a survey. It's not a survey. Surveys are something that you have an option to answer or not. If you are in business in any way, shape, or form, you are legally obligated on a quarterly basis to report your headcount to the Census Bureau. And that is why it's considered to be the ironclad end of the story. No more revisions ever to the originally announced payrolls data. The 830,000 job swing you mentioned is where we thought we were in the 3 months ended September 30, 2023, and where the census found out headcount actually was. We call the 830,000 survey data. It's soft data. And then there's the hard data that comes out of the census, which was a negative 192,000. I'm going to play Socrates for a minute and interrupt your flow. And I apologize.
Yeah, please. Sure. Go for it.
Let's just say, for example, because we found out with an initial revision to the birth death model in late July, we found out what the birth side of the birth death model looked like. So that was quantified. And the Bureau of Labor Statistics said, well, when we get the QCEW, we expect that it's going to show improvement from this initial revision. Why is that? Well, it's because our assumptions are that small businesses flipped from a negative 0.5% to a positive 0.6% contribution to fewer deaths. And we anticipate that the large companies in the country actually became more of a drag in the fourth quarter of 2023. So I'll give you the answer in just a second. So here's my question to you. Could you ever envision having 6 months of data in hand showing net job destruction and the National Bureau of Economic Research not identifying those 6 months, that 2 quarters, as a technical recession?
I mean, I would say a sane person wouldn't. With the BLS, I mean, who knows, right?
BLS is not the National Bureau of Economic Research. It's the
BER that declares a recession, yeah.
To date recessions. And if you have in hand hard data from the census that shows you had net job destruction beginning in the third quarter of 2024 that continued through the fourth quarter of 2024, kind of hard to turn your back to that.
So let me ask you a question in response to that, because I get asked this question all the time. Is that because A, the BLS is just bad at their job, B, because their models got blown up because the massive distortions that were created in hiring and firings throughout COVID are still rippling through their models, or broke their models and are still rippling through it? Or C, is it political pressure to make things look better than they really are?
Yes.
Okay.
Yes, and let me tell you why it's yes. Speaking of those models, we know, because we actually looked at the hard data on a quarterly basis. We put it into a quarterly siloed basis beginning in the first quarter of 2022. We aggregated dailyjobcuts.com closings into a quarterly basis, and we aggregated Bloomberg's BCY function, which is large companies that are filing Chapter 11 or Chapter 7 with 50 million or more in liabilities. So we tracked the 2 separate ones, because the BLS is saying when we get our final death toll of businesses, we know it's going to be influenced over here by small business deaths and over here by large business deaths. Both of their assumptions for the fourth quarter of 2023 are incorrect, because we know from dailyjobcuts.com that we went from 690 to 790 from Q3 to Q4 of closings. So the BLS's assumption is completely backwards. The death toll is going to be much deeper than what they're expecting. And we know from Bloomberg's BCY function, large company bankruptcies with 50 million in liabilities or more, that the number of large business bankruptcies declined from the third quarter to the fourth quarter of 2023. The BLS's assumption there again is in the wrong. It's got a negative sign and when it should have a plus sign. So we know that when the dust settles on the fourth quarter, that my Socratic question is going to reveal that we did actually have 6 months of job losses at the end of in the second half of 2023. And that's why the McKelvey rule was triggered in October of 2023. Bloomberg Economics right now is saying that they believe net job losses began in earnest in October 2023, and therefore that is when the recession began. That's why I'm not the crazy lady insisting we're in recession. It's not me, it's data.
Got it. Okay. Now the question is, and I'm glad you fast forwarded to kind of the key question I wanted to ask here, which is, if it is all about the data, we seem to have a lot of people that are looking at flawed data, right? So in other words, the Sahm Rule, which is also derived from or was the McKelvey rule, that just got officially triggered on Friday, right? But when I interviewed Claudia Sahm last week, I asked her, because we got a little bit into the data integrity question, and I said, how confident are you in this data? And at the time we were talking, the Sahm Rule had not been triggered, but I was like, could the data be wrong enough that if we had better data, it might actually be already triggered? And her answer was sort of like, maybe it's a tough time to be an economist right now, because more often than not, the data is a lot harder to have confidence in. But, Jerome Powell, and I know we're going to talk about the Fed in a little bit, but Jerome Powell, just last week was being uncharacteristically pressed by a number of the journalists at his press conference, saying, hey, are you telling us everything's fine, but back to the jobs data, like, are the jobs really as good as they say they are? And he kept saying, hey, look, jobs market is, sure, the numbers are coming down a little bit, but I call that normalizing. I see nothing to be worried about yet, right? And then voila, the Sahm Rule gets triggered. We're now talking about, the data that's scaring you. Are the people that are running the ship using the wrong data? That's the question I've been trying to get to here.
Nominally, they're using the wrong data. In reality, Jay Powell wants to be able to have enough time to press forward and complete Basel III Endgame, which begins to regulate the non-banking system. So nominally, he needs to hang on as long as he possibly can to keep higher for longer in place for as long as humanly possible, because the longer it is, the more you smoke out all of the distorted valuations in the non-banking, private equity, private credit sector, et cetera. So he's hiding behind data that he knows is wrong. He's already said it out loud. I know that payrolls are overstated. He knows he's quoting the wrong data. He's not stupid. He's Jay Powell Esquire, not Jay Powell PhD in economics.
That's a great way to say it. Okay, I'm going to have to ask you to define a couple things because I'm not sure everybody understands two of the terms you just mentioned there. One, can you just briefly describe Basel III and its objectives?
So the non-banking system globally is $240 trillion. It is unregulated.
All right, sorry, I got to interrupt you here because this was the other term, non-banking system. For folks that don't know what the non-banking system is, what's your 1 or 2 sentence description?
So non-banking system, $240 trillion, unregulated, every pension, every money manager, the BlackRocks of the world, the private equity firms, Blackstone's, KKR, Apollo, anything in the private realm, hedge funds, anything that's not regulated, anything that you wouldn't expect to see SPC or FDIC on.
Okay.
So, or whatever that equivalent is in the rest of the world. So 240 non-banking global financial system, $180 trillion conventional banking system. So you see one's larger than the other,
Yeah.
but only the smaller of the two is regulated. Basel III Endgame endeavors to regulate, especially at the intersection of the symbiotic relationship between the banks providing funding and oxygen and lifelines to the non-banks. That's the intersection at which systemic risk lives. Mm-hmm. Because you're going from what is seen in the conventional banking system, you're crossing a line into the shadows, into the shadow. It's also called the shadow banking system, into what you cannot see. And so beginning to regulate some of these monsters that are bigger than any US bank in some cases is paramount to, I think, Jay Powell's mission before May of 2026, when his term ends. But in order to continue seeing things like a Blackstone cut its dividend, which nobody thought could happen, you have to keep the fire to the feet. And higher for longer is what smokes out bogus valuations.
Okay, so just to be super clear, what Powell is hoping to do is to get rid of the excesses in the non-banking or shadow banking system, which doesn't have any regulation in it. So this is my interpretation. Correct me if this is wrong. He's concerned that likely in the public markets, we have overvaluation that you and I have talked about in the past. That's probably a lot of that's being driven by the non-banking players, and of course, there's the private market as well. That it's very opaque and could have a lot of overvaluations that we just don't know, right? So
everything that's called private is part of the non-bank. It's part of the non-banking sector. It's under that umbrella.
It's under that umbrella. I just mentioned the public markets, and correct me if this is wrong, but pensions and hedge funds, whatever, they're taking oftentimes a lot of private capital and then putting into the public market. So it has an impact, right? So my point is what I understand, I think you're saying is just like we had a banking system cascade in 2008. Right. Powell is saying, look, I want to diminish the odds of that happening again. We're doing what we can in the banking system because we oversee it as the Fed. I want to try to tame this shadow banking system, not non-bank system. And the tool I have to do that is high rates, where I can basically start to break the people that are overextended, and that, as they as they have to basically hunker down, or at least take some of their most speculative plays off the table, that reduces the risk for everybody. Do I have that correct?
You have that correct. They would probably change the name of the building from the Eccles building to the Powell building if he succeeds. But that's why there's all this chatter. Gee, will Jamie Dimon be the next Treasury Secretary? Blah, blah. Anything like that could happen and stop Basel III Endgame in its steps and just thwart the whole thing. Because let me tell you, 75% of JP Morgan Chase's business model is serving the non-banking sector.
Non-banking sector.
That's where they make their bread and butter. Prime brokerage, funding. We've gone from having a counterparty risk problem when Lehman failed to having a liquidity risk, a liquidity exposure problem now.
Okay. Does Powell need to watch for a knife in the back here? We talked about how inside the Fed, in the past, it was like Game of Thrones, but this seems like everybody in the financial system may want to get this guy out of town because the sheriff is maybe too effective. He's ruining the party for all the people that are, prospering from the current system. You're nodding as I'm saying this.
Well, Supreme Court precedent dictates, without getting into it, this is from 1933, when I believe it was, I can't think of the president. Shame on me. Was this post-Roosevelt? Anyways, the Supreme Court precedent dictated posthumously that a head of a federal agency could not be removed if it was not for cause. If it was for political purposes, you could not remove the head of a federal agency. Because that Supreme Court precedent exists, the members of the Federal Reserve Board in Washington, D.C., whose email addresses end in .gov, could opt to keep Powell in office. If somebody tried to fire him, they could opt to keep Powell in office until the Supreme Court ruled on whether or not that was legal based on this 1933 precedent.
Got it. So yeah, and I think we've talked about this in the past. Trump has made different statements, but threatened at one point to get rid of Powell. It seems like it would be very hard for him to do that politically if Trump were to get reelected here. But my question was just more sort of like, should Jerome Powell be careful getting into elevators and stuff like that right now? Because it seems like everybody, not just potential presidents or whatever, like everybody in the system is saying, we don't want this guy here because he's ruining the party.
Yeah, the Wall Street Journal editorial board did a very good, wrote a very good editorial that basically said people are already clamoring to blame the Fed, when in fact, if you look at job creation in the private sector, it's dwindled down to nothing. It's public policy, not monetary policy, that's caused this problem.
Got it. Okay, so the journalists, like I said, they were uncharacteristically, I think, giving uncharacteristic pushback to Powell in his Q&A last time around, especially around the jobs market, and coming out of that, plus with the triggering of the Sahm Rule, we've now seen a bunch of headlines saying, oh my gosh, markets are freaking out that the Fed is behind the curve here, right? And I'm guessing you would say, oh, that's kind of by design, right? Where Powell's got an ultimate objective here, that a bigger objective that he's pushing for. Now, Powell is kind of showing the markets that, hey, I'm getting close to cutting probably. I mean, I think he's pretty much got the markets to expect a September rate cut here. Do you think that he would can he start cutting? Now, a rate cut or two is not going to make a huge difference over the next couple of, quarter or two, but can he start cutting and still hit these Basel III objectives by the end of his tenure? Or is he going to have to pull a Lucy and pull the football from Charlie Brown here and say, hey, it's September, no rate cuts?
I think that it's game over for Jay Powell. We forget that the night before the FOMC press conference, that Intel laid off upwards of 18,000 employees, even though it's obviously taken an $8.5 billion loan. I think the gloves are off in corporate America. I follow Macro Edge job cuts very closely. They do a great job. They're very transparent in how they tabulate and tally job cut announcements. On average, they've been north of 100,000 for the last 5 months. That's an extraordinary number for a seasonally benign time of the year. And as we're taping this, they're north of 40,000 7 days into August, for heaven's sake. So Jay Powell's not going to have a choice on September the 18th. And he already allowed Nick Timiraos to write about the 50 basis point cut. So that cat's already out of the bag.
Okay, and that's interesting because he was specifically asked,
Yes, it was.
and he said, "Nah, I don't see anything," right? But again, what can he say publicly versus, what can he really do?
Well,
Okay,
actually, no, he's going to have to eat crow. Sorry.
yeah. Well, okay, so we will track, but fascinating. So just to wrap up the employment part here, you and I have talked both on video here, but also on our respective Twitter feeds about AI. And, on one hand, there's been a tremendous amount of market capitalization that's been added with hopes of what AI will do to the economy. And there's a whole discussion we could have, which I don't think we need to, but we could have about, is that at risk? Increasing amount of headlines coming out about CEOs and companies, kind of beginning to question the ROI of their current CapEx spend on AI, right? Like, is it worth the hundreds of billions that we're pumping into this thing right now, right? So there's, I guess, leading all this to say there's a risk that AI could really lead to a market repricing here if people realize, you know what, we just overbid these stocks and they got to come down. Before we talk about that, if you want to, let's talk about the impact of AI and jobs. So just this morning, IBM put out a statement that basically said, all the companies that we're helping implement AI solutions, they're pretty much using it for cost optimization. They don't really have big goals for revenue generation around it, right? So if you take that at its faith and say, okay, it's all about reducing costs then, well, where are those cost reductions going to come from with AI? And when you really think about it, it's pretty hard not to think that AI equals massive job losses at scale, right? At least that's what I think. What do you think?
Again, what I think is irrelevant here. The Atlanta and Richmond Federal Reserves, along with Duke University, the Fuqua School, put out a CFO survey on a quarterly basis. In the first quarter, there were 74% of CFOs that said they were using AI to reduce costs in the form of getting rid of warm bodies, getting rid of workers.
Expensive humans. Yeah, that's what humans are expensive to employ.
And in the second quarter, among the large companies that were surveyed, 85% of CFOs said that they were using AI to fire people. So I think the beauty of a CFO survey is it's anonymous. So you don't have to get out there and say, hey, we're ABC Corporation and we're firing thousands of people with using AI. It's a survey. You can just say, hell yes, I am.
Right.
And show that indication. But 85% of large companies in America are using AI to fire people. And that's a tangible number. In addition to that, you've got existing employees really fearful at this point because their kids are telling them about the wonders of AI, but they don't know how to implement AI to make themselves more productive in the workforce without some serious training. It's not like you just pick it up one day and say, okay, I understand how AI can optimize my position. So instead, you've got your average worker working their tail off and just working a whole bunch in addition to AI being implemented. So you're seeing something that you didn't see in recessions prior to 1990. What is that, Adam? You're seeing productivity go through the roof because your workers are working harder. The workers who came back into the office as quickly as they could and didn't say, I insist on working from home, and they didn't even get to finish the sentence before they were fired. And when they are there, they're using AI to the extent that they can, and they're working longer and they're working harder. So productivity right now, it's completely out of the economics textbook. It's going through the roof.
Okay. Although is this a blip in the journey? In other words, people are scrambling hard because they don't want to get replaced by AI, but as AI fully comes online, do they start
it seems like that's the direction
workforces?
we're going. I mean, it really does seem like that's the direction we're going. And again, companies keep in this earnings season, we talk about so many companies are beating their profit forecasts. But how many people are talking about how many companies are missing their revenue forecasts? It's a sales thing. You can't fudge sales. And if you've got pressure on your top line, you're going to keep cutting costs.
Okay, so I'm trying to get to the consumer story, and we're making our way here, but you're layering a couple important things on top of each other. One is what I hear you saying is, look, folks should plan for a recession. In fact, we're probably already in one by certain definitions, but correct me if I'm wrong here. You think that it's going to become more noticeable and it's something we're going to feel more as time goes on here, right? Like now there's still a lot of debate about, are we in a recession? And
There
one
may be
question,
debate in our world, Adam, but 3 out of every 5 Americans think we're in recession. So I think the debate is occurring in our world. That makes us insular.
yeah, so I'm with you in the sense that you talk to the man on the street, and 3 out of 5 people on the street will say, "Yeah, my life's rough," right? There's still 2 out of 5 that are doing okay, and especially if you're on the higher end, you're doing great
Oh,
because
absolutely.
financial assets.
That's the K. You know,
It's
that's
the K-shaped recovery, right? It's that smaller up to the right K.
Yeah, but that upper right K is a little freaked out after the Nikkei dumped it. Even though the Nikkei came back, that upper part of the K is going to be pulling back. They're
Great.
spending.
All right, and that's where I'm going here. But right now there is debate, and the question I didn't throw back at you, which maybe I'll just do right now, is there are people who are like, Danielle, what are you talking about? GDP for Q2 just grew at 2.8%, right? So there's still ability to pull, cherry pick whatever number you want to say, right? And not everybody on the street, you know, is got a cup in hand or out of work or whatever yet, right?
Sure.
So my point is I think what you're saying is at some point in the future here, and maybe you tell me end of the year, middle of next year, it's not going to be a debate. The question is going to be is when the hell are we going to get out of this depression? Not are we going into a recession? Not are we going into one? Right?
Look, it took Anna Wong, who's the chief economist at Bloomberg, put out a great chart overnight that showed that it took 6 quarters before we finally had the final revision that showed that in 2001 we'd gone into recession. So that GDP print that started off with a 2 handle eventually was a negative number.
After it had been revised down over the different revisions?
After it had been revised down.
Yeah.
For the 2007, 2009 era, we had the final revision to that recession's GDP numbers in 2018.
Okay, great. So it still may be a while,
Again,
but
Adam, you know, this is actually an important, really quick point.
yeah,
Remember we talked about 830,000 people.
yeah.
So in the GDP numbers, it's assumed that those 830,000 jobs existed. And that therefore these 830,000 ghosts were producing income.
We're contributing to GDP, yeah. So the question is, how much is GDP?
It takes a long time to back it all out.
Yeah.
But that's what we figure out as a factor of time. So I love the red herrings about GDP being so strong right now. I'm like, great, but go look back at recessions and tell me, when did we find out that in December of 2007 that the US economy was contracting? Well, it sure as hell wasn't any. I mean, it was barely in 2009. It takes a long time for this to filter through to the data.
Okay, very useful, because you're making the point I'm trying to make here, which is that people shouldn't be complacent about the debate right now. Oh, well, they're debating, so maybe it's not really there. I think you would say, hey, folks, err on the side that it is a recession, because historically, once they do all the revisions, they prove that we are in one. And so if you want to just, you know, make sure you and your family aren't blindsided by what may, you know, be arriving here, spend some time right now figuring out, hey, what can I do to preserve my income stream, make myself less vulnerable at work, that type of thing. You're nodding as I'm saying this. And by the way, I'm glad you mentioned Anna Wong. I interviewed her about 2 weeks ago. She has the highest prediction on the street for the unemployment rate at the end of the year. At least when I interviewed her a few weeks ago, I don't know if she's changed it since then, it was 4.5% is what she thought the unemployment rate was going to be. And she said, hey, in a recession, the unemployment rate can go a lot higher, 6, 7, 8%. But she said, I think by the time it hits 4.5%, the debate's going to be over. It's going to feel to everybody like we're in a recession. We'll see, but it seeks like you're of a similar mind.
Well, I mean, historically speaking, when the Fed actually begins to lower interest rates, that's when you exit the seesaw pattern of up 500, down 500, up 500, down 500. That is very typical of 2007, the year 2000. That's how markets behave. They're all over the place, very volatile, until the Fed actually cuts rates. When the Fed actually cuts rates, Katie bar the door, that's when the downline stays down. And if that's going to be the case, then you're going to have a reverse wealth effect. And that will make the K-shaped economy, it's going to flatten that puppy out. It's going to look more like an R.
Got it. Yeah, it's going to take that top part and start moving it down to the other.
Even if people's wealth is there, they're still going to be like, oh, wait, batten down the hatches. I'm not going to spend as aggressively as I would otherwise, especially because, oops, my house just, my home value is going down so damn fast, which nobody ever told me that was going to happen. They said it was only commercial real estate that was going to get hit, not residential.
Great. And so we're going to talk about that too in the time we have left. To your point about, hey, historically, when the Fed starts cutting, right, that's when that's when the wheels come off, right? I mean, that's when we begin to really feel that we're in a recession, the Fed starts panic cutting, and we experience the full brunt of the force of the recession. And it's only after quarters before the Fed's efforts begin to start to re-stimulate the economy, we start to get out of this thing, right? So you're making my point here. And so my point number one is, look, we have these concerns that we're going into a recession, and people should be concerned, especially if you work for a paycheck in this environment. Don't walk into it blindly. That then sits on what we mentioned earlier, which is companies have been investing hundreds of billions of dollars into AI. I've lost track, but I think we're maybe like in the 800 billion, range now. And it takes time for all that investment to get deployed and everything. And from, I believe what you've said, you think that we're going to see a growing effect from that of the need for less and less employees as AI gets better at replacing human labor, right? So we basically, what I'm trying to pull up here is we have twin threats to labor right now. And I guess we could maybe even add the third threat. Maybe this would be under recession, but I talked about kind of the bubble in the market, whether it's AI stocks or just people are looking at the earnings expectations for the S&P for next year, and it still seems really hard to believe. If we have a market correction in here too, that's also going to influence companies to start having to lay off people. So there's kind of this triple threat to labor right now. I just want to make sure that people watching understand that. I'm not trying to freak people out, but I'm trying to say that, like, you should be planning. You should be coming up with a plan B or C. Do you agree?
The thing that I watch the most closely within the data, within the job market, non-farm payroll Friday data, is the work week. Because if you press that down too much, that means that you're trying harder and harder and harder and harder to not fire people.
Yep.
You can only take that down so low. Where do you think the US economy was in the Great Recession timeline when the work week hit 34.2 hours, which it hit in July? How far out of recession, into recession, Adam, do you think the US economy was when it hit 34.2 in the Great Recession?
Help me out here. Was that the low it hit?
It wasn't the low, but it was 9 months in, the month that Lehman collapsed.
Okay, so
when we thought the world ended, that's the first time it got as low as 34.2 hours. In other words, companies have cut to the bone hours. It's a rubber band getting ready to snap. Because now companies don't have a choice. They're actually going to have to get rid of labor. They're going to have to fire people. They've cut hours as much as they feasibly can.
So this point's been made before, but you're making it again, and I think it's great, made along with that sort of sandwich analogy I was trying to create here, which is, again, you should be very careful if you're labor here, because companies have been labor hoarding, right, since they had to fire everybody and then they had trouble hiring them all back, right, during the COVID time. So generals always fight the last war. They've been doing all they can to not have to fire those people. And so what happens is they do every trick in the book to try not to fire people until they're out of tricks. And then they have to, it's just a cascade. I sort of liken it to like being a balloonist, and you're trying to get altitude and you're trying everything you can with the fuel you have in the balloon and the flame and all that stuff. But once you realize it's not enough and the balloon is sinking, you just have to start chucking weight out of this thing, right? It becomes sort of an existential, I just got to not have a crash landing thing, right? So these layoffs tend to happen big and fast, right? You're just sort of nodding as I'm saying this, and I think that's the point. So it sounds like you're agreeing with the point that
Well,
I'm taking away from you.
I'm agreeing that CEOs and CFOs agree with you, because that's what they're doing. I mean, we had what, upwards of 18,000 last week at Intel. Dell this week was like 12,500. I mean, they're not, and CEOs care about their job and their bonus. And both of them depend on, earnings per share.
Right.
Challenger Gray and Christmas does a very good job of tracking CEO turnover. There were 909 CEOs that were replaced in the first 6 months of 2023. And that was an all-time record. It blew away by hundreds of CEOs, any precedent. In the first 6 months of 2024, we've had 1,101 replaced. They are calling in the henchmen. They're calling in agnostic, dispassionate, disconnected individuals to come in, and the board of directors is saying, your job is to fire people.
You're the hatchet man.
Attached to any of them. So go do it.
Okay. All right. So this is the reality that we're in. Let's touch base real quickly. I want to get to your market outlook and as we wrap up here, but let's get real quickly to the state of the general state of the consumer right now. So right now, obviously, I hear you saying the consumer, a lot of them are not feeling great about their job security and should be worried about it for good reason. What else are we seeing on the consumer in terms of their spending, household balance sheets, stuff like that? Are they at recessionary levels too?
They are, according to the New York Fed delinquency data that came out yesterday. And we are seeing the distress in the household sector at recessionary levels, not in housing, certainly, but the average American family now pays more in non-mortgage interest expense than they pay in mortgage interest expense. That's how much extra debt they've got. And nobody wants to talk about it. I know that the Biden administration, I know that the Biden administration forgives countless amounts of student loans on a daily basis, but they're not forgiving the people who owe a lot, who make a lot of money. And they pay the piper starting November the 1st. Their FICO scores get hit starting November the 1st. There were 20 million Americans repaying their student loans with the most recent data. There were 19 million who were not repaying their student loans. Whoever in that 19 million pool of people not repaying their student loans who don't have it forgiven, their credit's going to be destroyed on November the 1st.
Wow, and that's almost
half. They haven't been paying since November the 1st, 2023, when the obligation to pay kicked back in. But Biden wanted to give them until Election Day before it actually hurt. But that's coming, and it's coming in just a matter of weeks. It's like happy Halloween, boo, there goes your FICO score. So where we are now and where we're headed are night and day. We ain't seen nothing yet.
We ain't seen nothing yet. Okay, maybe that's going to be the title for this video here, Danielle. All right, just before we hop off consumer, I just got to ask you your thoughts, quick thoughts on the housing market. That's hung in there a lot longer than most folks thought it would, and obviously a lot of homeowners are hunkered down, crossing their fingers, hoping the Fed's going to ride to the rescue and that lower rates are going to mean housing prices start rising again. What is your take?
Well, I think on a not seasonally adjusted basis, we got a gigantic 0.3% increase in purchase applications in the most recent week, with mortgage rates falling to 6.55%. So mortgage rates aren't making a difference. They're not moving the needle. And I get tickled, Adam. It doesn't take much to tickle me, but when you tell me that the exodus to the exurbs that followed the pandemic was specifically to no state income tax states, and then in the same breath you say, well, it's only Armageddon in Florida and Texas in housing, where inventory is going through the roof, where homeowners insurance is spiking, but it's only Florida and Texas. We don't have to worry about that. And I'm like, where did everybody move? Just asking, just asking.
Yeah.
So, it's seeing the explosion in inventories, watching a personal close friend who's moving from Indiana to Dallas, see the number of empty rentable homes that are coming on the market on a daily basis, watching these Airbnb jocks run and hide because their financing, which involves some form of a Ponzi scheme, has run out, is remarkable. The speed with which we're seeing housing slow is remarkable.
Okay. Do you think housing will be like your outlook for recession, that like in a year, it's not going to be a debate whether housing is going to avoid a downturn or not? It'll be inarguable. We're just in it.
Yes, I think the discussion will be over.
Okay. All right. Let's see here. So many questions I want to still pull with you, but I'm gonna try to land the plane here around the markets. So let's talk about your market outlook here. So I guess even without asking a leading question, how do you view the markets right now?
So unlike those who are dismissing the move in the markets and making it akin to an October the 19th, 1987 moment, we didn't see near the decline on a percentage basis
Right.
in the stock markets. I certainly don't characterize it as capitulation, but it's the reasoning that they're using as to why it's the same as 1987 and therefore we need not worry. I'm like, well, in 1987, were layoffs going through the roof? Oh, wait, no, nor were we even flirting with a recession at the moment. So the economic backdrop matters a lot.
Mm-hmm.
And until we see capitulation, I think that what we've seen in the markets with the terrible Monday with the Nikkei and the reaction in the United States and the tremendous gapping out that we saw in credit, I think what we've seen is where we can go and where we're headed. It's not going to be overnight. It's not going to be in straight line fashion, but I think that the markets have shown us a glimpse of what their capacity is to inflict damage. And we have to remember that this is a lot like 2018, which got started off with Volmageddon, in that there is a corporate bond market that's highly at risk. The difference between then and now is it's a hell of a lot bigger.
So let me ask you this. It's a question I've asked a few people, but I'd love your thoughts on it. So first off, let's put it in perspective. The S&P is at what, 5,200 right now? Its all-time high is 5,600-ish, right? So, I mean, we've had this sell-off for the past couple of weeks.
And stocks all the way back to where they were in June.
Yeah, exactly. I mean, this is not like, Black Friday or whatever, right? I mean, let's put it all in perspective for the time being. But I think your point is the reaction to the market is either things are perfect or, oh my God, the world's ending, which I think is a sign of sort of being on a knife's edge around sentiment. So let's talk about sentiment for a second, because my thesis, but I think for markets to turn, you have to have a change in sentiment, right? The net buyer has to go from feeling net bullish to wanting to sell, right? And what's interesting is I've seen more and more people. In fact, I just retweeted, I'm forgetting who it was today, but a fund manager who basically just shared online that, hey, we've been positioned net bullish since whatever, October of 2023. We've now just changed our models such that we are now neutral, right? And that is a sentiment shift. They're becoming less bullish. Their sentiment is moving away from bullish, right? So the question I asked is, interesting. How many other capital managers are doing the same thing, right? Are we having this rippling change of sentiment? I don't know. We can debate it. We're postulating right now. We don't have enough data. But where I'm going with this is we had a national example on how sentiment can shift very quickly. And I'm going to use, I've mentioned this in this program a few times before, but I'm going to use the presidential debate between Trump and Biden, right? Where up to the hour before that debate, if you talk to the heads of the Democratic Party, they would have felt pretty good about their chances. Everything's fine. If you were talking to them, they would say, look, there's absolutely nothing to question about the president's fitness. He's great. Everybody pretty much took that at face value. Yeah, we've seen some things online, but they're telling us those are deep fakes or cheap fakes or whatever, right? But within minutes after the debate, national sentiment had shifted. Enough people had changed their minds, and I'm not making a partisan comment here. I'm just observing what happened. that all of a sudden things that were inconceivable were suddenly conceivable. And then we had a lot of change happen, right? I mean, very quickly, we replaced the presidential candidate for the Democratic Party with only a few months to go, right? And I'm just wondering, does that unlock the question in people's mind of, well, what else have we been told is fine that may not be fine? Does that open the door for some of these big sentiment shifts where people could really start questioning the employment data? They could start questioning the strength of the economy or whatever. Does that make us more vulnerable to a sentiment shift that could lead to a big major market repricing?
It does for a very demographic reason. Adam, if you have, we have to remember that because early 2020 happened so fast that retail investors didn't get burned to a crisp like they did in 2007, 2009.
Yeah.
I mean, the Fed,
because they got rescued so quickly. It was a big bounce, right?
Huge bounce.
Yeah.
So you ended up having, as a consequence, fully retired individuals having greater exposure to the stock market than they've ever had at their age.
And sorry to interrupt, but yeah, not just the risk profile is much higher than it has ever been for that age cohort versus previous ones.
Right.
Yeah.
Now, what's different between 2007 and today? It's the solution. The solution has changed. The solution for this cohort was in 2008. I'm young enough to go back into the workforce. I'll just re-enter the workforce for another decade and make it back. Yep. I'll just earn it back. They're in their 70s, Adam. They can't. They cannot re-enter the workforce, which means, to answer your question, the contagion, the vulnerability to contagion, the risk of contagion is so much higher because this cohort is still so big. So if one of them goes, they all go. And we've already seen net redemptions in January and February from Vanguard's Total Stock Index Fund, largest ETF on the planet. We've already seen net redemptions in January and February of 2024. Since then, it's flatlined. If there was to be a moment of mass redemptions where we're also seeing very few new entrants to the workforce, where we're also seeing firings going on, especially in the white collar community. And if you were to see this heart attack among people in their 70s selling together because they don't have a demographic solution, they cannot go back into the stock market. Excuse me, they cannot go back into
the jobs market.
The job market, and the rest of their net worth is in a really overpriced home that millennials don't have the kids to move into. It's too big and too expensive. So if they see their net worth eviscerated and they all move at once, that in and of itself would and could matter, Adam. But it really matters because you flip the flows. And we don't know what that looks like. You don't know what it looks like. I don't know what it looks like. Nobody knows what a flip in passive looks like. Not a person on planet Earth, only God.
So you are doing an excellent job of putting your finger on a big part of why I do what I do. And people, I get it. We'll say, Adam, you're too bearish and you're always here, waving the bear flag. And I'm really trying not to. I'm just trying to have intelligent discussions about
it's just data.
What probabilities
I
are.
didn't make it their average age. Their average age is their average age.
Right.
And they're more exposed to the stock market than they've ever been. That's not your opinion, and that's not my opinion. It's just fact.
It's just fact. So another fact is the people that watch this YouTube channel are 2/3 45 years and older. There's a lot of retirees. There's a lot of people that fit into the cohort that you're talking about here, right? And so I just want to make sure that as many people who are at risk, I mean, everybody's at risk of the implication of what you're talking about, whether you're young or old, because it's going to impact the financial markets. Anybody who's, exposed to them or exposed to the second and tertiary effects of, companies laying people off if they're stock traders, right? They're all going to be affected, but the folks affected most are going to be the older people who cannot go back into the jobs market like you talked about and earn it back. I mean, so we could, I'm not saying we're going to, but we could be having kind of a generational crisis coming out of this, where you get I mean, we already have a pretty big crisis with the boomer generation, where on an average basis, it's a little embarrassing looking at what the average net worth is for boomers to retire on. But when you look at it, the median, it's just insultingly low, scarily
Fastest
low.
growing cohort in America of homeless people are north of 55 years old. 50% of them work their entire lives.
Right. And that's today. That's today. If what you're talking about happens, we could be taking the half that is good off, well enough off, and injuring a material part of them as well, right? With not enough time for these guys to recover. And again, I'm not trying to sell fear or whatever. I'm just trying to say there is a cogent argument that folks should keep in mind that you've just made really clearly here for folks. So, okay, I'm sorry that we're going to be sort of ending on this, but it's a big concern to keep in mind. And again,
It is, but if you're of that age and you know you cannot go back to work, even if we take the Fed funds rate down by 50 basis points on September the 18th, you're still getting 5% on your cash. There's absolutely no reason, if you've listened to the two of us for the last hour, you cannot go collect 5% on your cash.
Exactly. And that's my whole point, which is
and just eat your popcorn and watch what's about to play out.
right. De-risk, right? Because what you're basically saying is look, for a long time, especially during the ZIRP era, you had to pile into equities and things that gave you a higher return to be able to retire and hit your wealth goals, right? So now we're in a different world order, and some of the things that you might be depending on may not come back here. And here's one. We talk about things that people are so rock sure of that maybe sentiment might change of. Here's one that I think everybody's rock sure on, and I'd love to get your thoughts on it, which is, don't worry. The market goes down, gets low enough, Fed's going to ride to the rescue, and everything's, it'll be by the dip, right? And almost everybody I talk to think that's what's going to happen. We're going to have some sort of market correction as the lag effects really arrive in here, and then the central planner's response is going to be gargantuan, and nominally asset prices are going to shoot the moon again. And I'll say that's probably going to happen, but it might not. I don't know. What do you think?
Adam, there were 41 days with no junk bond sales before Powell was in enough pain to pivot. It's not about the stock market. If bond issuance freezes up, and it opened right back up, there were 10 huge investment grade bond deals that were pulled on Monday. If bond sales freeze, then you'll wake up Jay Powell. But he went 41 days without a single junk bond sale before he hit his pain point.
Okay. And so therefore people expecting the cavalry waited an awful lot longer than they thought they were going to.
The stock market's not going to move that, man. It's not. It's about the credit market. The Fed is duty bound to keep capital markets open. That's why the Fed conducts a senior loan officer opinion survey, because it's duty bound to keep banks open and lending, and it's duty bound to keep the capital markets open to lend to corporate America. If issuance dries up, that's a matter for the Fed to address.
Got it. And that's called the slews, right?
The slews, yes.
Yep. Okay. All right. Gosh, many more things I could ask, but we're at the end of your time, Danielle, so I got to let you go. Real quickly, just in terms of the outlook that we've just described, are there assets that you think are likely to perform better, that are worthy of consideration? Not necessarily an endorsement on your part, but just worthy of consideration. And are there any that you would just say don't touch with a 10-foot pole right now?
I mean, I think right now, given the rapidity with which we're seeing the layoff cycle accelerate, I think that building in deeper rate cuts than what we had recently is reasonable. So if you want to build a position, I think it would be at the short end of the Treasury curve at this juncture, one that's going to directly benefit from the Fed lowering the Fed funds rate. You can get a little bit of capital appreciation there that offsets what you're going to be losing in terms of interest income paid on your cash.
Okay. Yeah, and I guess that's just one thing to make folks aware of, which is if we do get those aggressive rate cuts, or more aggressive rate cuts than we initially thought, those fat 5%, T-bills, that's going to start going away, right?
Yes, and that is my point, that you can get capital appreciation at the same time that you're losing some of that interest income. But again,
Okay.
nothing's worth losing a gigantic chunk because you're 80% in the stock market.
Yeah. Okay. So then when you say short-term treasuries to try to get some of that duration repricing, was that like 5 years?
I think
Yeah.
I think that that's reasonable. And again, unless we have a credit crisis, unless we have a full-blown financial crisis, I think that this Jay Powell wants to stop with at the most, at the least a 2% handle on the Fed funds rate. So I don't think that this Jay Powell, unless he's forced at gunpoint, is going back to the zero bound or quantitative easing. I think he's going to let these mortgage-backed securities, as prepayments pick up, roll right off the balance sheet at an accelerating pace.
Okay, interesting. So, okay, so we won't go back to ZIRP, although 2% is still,
Still very low, but it's not zero.
yeah, it's a big move, but it's not ZIRP. But QT continues for the foreseeable future in your forecast.
Yes.
Okay. All right. Well, Danielle, look, this has been, as always, super enjoyable, super informative, super valuable. Thank you. Very important question. For folks that would like to follow you in your work, where should they go?
Well, come to at DiMartino Booth. I still call it Twitter. Call me old fashioned. The only reason to call it X is because they have XXX bots. But do follow me at DiMartino Booth. I just crossed over the 300,000 mark. Yay.
Congratulations. Well deserved.
Thank you. And come to my Substack, dmartinobooth.substack.com.
All right, awesome. And Danielle, when I edit this, I will put up the links to both your X Twitter handle and your Substack, so folks know exactly where to go. Folks, I'll have those same links in the description below this video too, so you can get there with one click. So many other questions I'd love to ask, but I'm going to have to save them for next time. I do have one last question for you, but very quickly, I've got a little housekeeping to do, so just stick with me for 30 seconds. Folks, if you've enjoyed having Danielle on this interview, would like to see her come back on the program whenever her dashboard tells her that there's something really important that's new to the story here, please let her know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. And of course, I'm sure many of you watching are asking, wow, what should I be doing with my personal portfolio to prepare for the potential future that Danielle sees ahead? My strong advice is that to prepare for that, most of the people watching here should employ the guidance of a good professional financial advisor to help them think through this. Now, of course, you want to get a good professional advisor who takes into account and understands all the macro issues that Danielle and I talked about here. When you layer all those requirements on top of each other, the universe of available financial advisors that meet that criteria begins to get pretty narrow. But if you've got one of them who's doing a good job of coming up with a personalized strategy for you and then executing that for you, fantastic, you should stick with them. But if you don't have one like that, or you'd like a second opinion from one who does, then consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple of seconds. Again, these consultations are totally free. There's no commitment to work with these guys. It's just a free public service these advisors offer to try to help as many people as possible, position as prudently as possible in advance of what might be likely down the road. All right, Danielle, last question here. Look, you've had a fantastic career. You were an advisor to the Dallas Fed under Richard Fisher. You then became one of the most respected minds in macro. You've got just hundreds of thousands of people who follow you on X, Twitter alone. You've become a huge influencer. What's one important lesson that you've learned along your journey here that you think is worth sharing with today's audience?
I think what I had to learn the hard way is that on an empirical level, on the ground, there is no such thing as a stock versus flow debate. It is always at the margin, and flows are the only thing that matter. And if they are positive, it does not matter what your opinion is of the individuals making liquidity positive at the margin. That is going to make risky asset prices increase. It doesn't matter if it's a right or wrong behavior, as long as it is a net positive. When at the margin, you're growing the balance sheet, you're monetizing debt, risky assets are going to eat that up.
Okay. Super important point. For folks watching, if you've seen the discussions I've done with the likes of like Michael Green or Bill Fleckenstein, you'll know the importance of what Danielle just said. That's sort of the giant mindless robot of passive income flows that have been supporting the market, asset prices in the stock market in many ways to rise to levels that many people just can't understand. But inexorably, that happens when you have positive passive income flows over time. One of the things I'm presuming why you're really highlighting this, Danielle, is because one, you can stand in front of that if you don't like it and get steamrolled by it because it doesn't care. It's that giant mindless robot. The second thing is if it were to ever flip into reverse, it could have consequences that I would say the vast majority of market participants are just not imagining right now. And I believe you feel the same way. Is that correct?
I do indeed feel the same exact way, and we must respect demographics.
And I guess I'll just ask this last question to clarify for folks. If we go into the type of recession that you expect we will, with the scale of job losses that you think we may have, a large part of what's feeding the giant mindless robot is mandatory retirement purchases every month. So if we start dramatically decreasing the worker base, that's going to be less retirement funds going in every month. So in this type of recession you think we may go into, is there a risk of these passive flows flipping negative at the margin?
I believe that there is. The reason that we saw in the first 2 months of the year, the Vanguard's total stock index ETF turned negative net redemptions in January and February of 2024 is because we had an unexpected surge of early retirees at the very end of 2023. So you had a light switch come off of people no longer contributing to their 401ks at the same time that companies were not bringing new entrants into the workforce in white collar jobs with large 401k contributions and matching. And at the same time that they were firing a lot of white collar people, which has continued to this day. So mathematically speaking, your new entrants did not offset who was being fired and who was retiring. And we saw net redemptions. We saw it with our own eyes. We saw net redemptions in those 2 months as a response to a big blip in early retirees at the end of 2023.
Oh, okay. Well, then we're going to have to watch this very closely. Danielle, you always have an open invitation to come back on this channel, but if you see anything, in your dashboard that you want to get the word out about with extra importance, please come back on this channel anytime you want, especially if you start seeing these flows, these passive flows start turning negative on the margin.
Absolutely.
All right. Thanks so much, Danielle. It's always a joy.
Thank you, Adam.
All right, everybody else, thanks so much for watching.